Hello, my name is Shayne Laidlaw, analyst on the restaurants and consumer staples sector. We've now been short Chipotle for nearly 2 years, and we recently updated our short thesis. We were focused on why Chipotle remains a broken company today, why we remain short going into earnings, and then what would make us go long. And to the extent you have any additional questions or want more detail, please reach out. Turning to slide 33, we were highlighted on the AUVs returning slowly. So Chipotle of old had an industry-leading average unit volume of $2.5 million. It hit a low of $1.86 million in 4Q16 and has since recovered some. But during this time throughout their E. coli crisis, consumers have had the option to go out and find other restaurants as the consumer perception of Chipotle has completely deteriorated. As they found out, there's plenty of options where people do lunch just fine. Think about McDonald's upping the quality of their product. You have Wingstop, you have Firehouse Subs, Cava, Dos Toros, virtually copying exactly what Chipotle is doing. So all these competitors have come in and vultured these sales from Chipotle, and it's going to be very hard for them to regain these sales, and that's the only way they're going to regain their industry-leading margins in the long term. On slide 42, we talked extensively in this deck about why they need to cut new unit capital spending. We highlight on slide 42 both McDonald's and Starbucks, two companies that have done this multiple times throughout their history, and it has proven time and time again to be a growth driver of EBITDA. Going back to McDonald's here, they cut CapEx from fiscal year 12 to fiscal year 15 by 40%. And then on the Starbucks side, in the same 3-year cycle, they cut capital spending by 59%. Arguments are that Starbucks could possibly do that again here, but we won't get into that here today. So cutting capital spending on new units is vital for Chipotle to turn around this business in a sustainable way. Turning to slide 44, thinking about what Chipotle is doing as of today. Yes, they are slowing unit growth, but still at a high single-digit rate, they are growing too fast for the amount of problems they have. We're calling for a significant reduction in new unit capital spending specifically so they can focus internally on the core issues that they are facing and turn their existing business around. And that's what will enable them to further grow units in the future once they get past this problem. On slide 49, we're going to take a look at the new board members. We think this is a great start for Chipotle and think particularly Matt Paul is a great addition to the Chipotle board and has a pedigree of cutting capital spending from his time at McDonald's from 2001 to 2008 at a time period where they were facing some struggles. So they cut capital spending by 35% from fiscal year 2002 to fiscal year 2003 to focus internally on existing operations and turn those around in order to accelerate EBITDA growth. This was the first time they did it. They did it again later on from fiscal 12 to fiscal 15, which we spoke about previously, and he really knows what to do. The one issue will Steve Ells and the rest of the management team listen to what Matt Paul has to say? It's important to note, obviously, he got on the board, so they're interested in hearing what he has to say, but whether they implement it or not is the biggest question here that still faces Chipotle. On slide 55, just to summarize the margin picture of Chipotle and what has happened, what has deteriorated over the course of this E. coli crisis that they've faced with over the last 2 years. Restaurant level margins are well off their peak of the 28% range and well off the historical average going back to 1Q 2008 of 26%. And as you look out to this business, they're facing higher labor pressure, which they probably need to invest in order to turn around consumer perception of the brand. And they're also faced with higher commodity costs. So thinking about this line in particular, which is kind of served as a barometer of the health of the Chipotle brand, they're really going to struggle to get back to these historical averages. And that's compounded by the fact that their AUVs, as we showed previously, are well below historical averages. So getting this restaurant level margin back up to a higher level in the mid-20s is a long way off, and people need to come to grips with that fact before Chipotle gets kind of rebased and we look at it from the long side. Turning to slide 69, we also talked about in the presentation what would make us go long Chipotle. We're not long now based on various reasons, but I think looking at what would make us go long, leadership at the top of the organization they need to take on the founder's mentality. This is a book that we've adopted here, that we've read and studied here at Hedgeye, and Chipotle needs to study it as well because they really need to come back to their roots in order to recover this business. And I also highlight number 4 here is resetting growth expectations. We're calling for a 50 to 75% cut in new unit capital spending, which will signify an adoption of McDonald's Plan to Win framework, which we think is very vital to Chipotle returning to a sustainable growth rate. And so we're still standing by our price target of $250 as of today. And going into earnings next week, we're excited to see what Chipotle is willing to adopt as far as the new board members' input into the business. So thanks for listening today, and I hope you have a good day. And if to the extent you have any additional questions, please feel free to reach out.